investor poll surveys that shows 48% of Singaporeans put their money in cash, 18% in equities, and only 8% of them invest their money in property. What are the differences between investing in equities versus investing in properties in terms of cost, risk, and return? Let's look at it in this episode. The first thing is about capital commitment. You can open any stock account for free, and depending on which stock you want to buy, you can just invest a few $100s or a few $1,000s. And depending on what time and price you want to enter the market, you can buy everything at one go or buy in small batches at different times. Versus you want to invest in a property, you have to buy everything, the whole property at the same time. And it ranges from the price of a few $100,000 to $1 and $2 million or even few $1 million. You have to pay initial capital of 25% for down payment, 4% buy stamp duty, additional buy stamp duties, and also legal fee. And there are ongoing expenses like monthly mortgage, maintenance fee, and property tax. But if you buy equities, the only thing you need to pay is the commission and the holding fee. And then you can short the stocks, or you can even borrow money from the bank to invest in equities. Another thing is about the ease of entry. If you buy properties, there are a lot of borrowing restrictions depending on your age and the age of the property, depending on your income, and also your assets, your liabilities, the TDSR score. And it also depends on your resident status, whether you're Singaporean, you're PR, or you're foreigner. But if you want to buy stocks, it is non-discriminatory and enormous. All shareholders of stocks, they're all equal. It doesn't matter about whether you are a PR or a foreigner or a Singaporean. So everybody pay the same price for the stock. One important difference is about the ownership. If you buy a shares of a company, because you're not the senior management, you are not the CEO, you are not even sitting in the board, whatever decisions they make, you have no control over it. You have absolutely no say. You can't do anything out of it. Versus if you are one of the unit owners of a condominium, if you have any comments, feedback, complaints, you just make your way down to the management office, you can talk to them, and then you can lodge a complaint or write them a letter, and they have to deal with it. Oh, one big difference is the commitment of time. During the handover of the units, it's usually after work I would go down to the unit and the paralegal would give me the key and the documents. Because the place has been vacant for at least 3 to 4 months, is really dirty. Because if you are single or a young couple, most likely you have no maids at home, and it's so expensive and difficult to find a part-time helper to go to your place and clean it up. The only alternative is to do it yourself. So I would usually, after I collect my key, I would usually go to the nearest supermarket to buy a cleaning cloth, and then the mop, the broom, then the water bucket, and also all the floor cleaner to come back and do it myself. At that time, I'm sharing a flat with 2 other flatmates, and unfortunately that weekend, it is my turn to clean the house. So for that one weekend, I'm cleaning up 2 houses. And you have to make it more spotlessly clean compared with your own house, because you have a lot of strangers, like prospective tenants, coming to view your place. And finally, after one tenant find your place nice and they want to rent it, the price, everything is okay, and they suddenly open the oven door and said, "Oh, how come it is dirty? Can you clean it before the handover?" And then I look at my agent and find the agent looking at me. So no choice, you still have to do it. So after you rent out your unit, whenever the tenant find the aircon or the water heater or anything not working, they will call you. But if you invest in the shares of a company, you don't have to worry about the renovation, the furnishing, or the repair of the office. If the aircon in the office is not working, the company is not going to call you. If you want to sell a stock, you can do it online with a few clicks. And then within a few seconds, you can sell a batch or you can sell everything. But because it's impulsive selling and some panic selling at times, so the prices can drop very fast in a short period of time. It can drop even up to 0. This is a very liquid asset for stocks, versus for properties, it's very illiquid. You can have impulsive buying for properties, you can go to a show fair, you like the place, and then buy out of impulse. But it's impossible to have impulsive selling for properties because you need at least 3 to 4 months to sell a property. The prices of properties won't drop down to 0, but it can drop beneath the material cost, like what they had during the subprime crisis in the US. And you can also have a negative equity, meaning that your outstanding loan is higher than the value of your property. In a market crash, it's not uncommon to see both property and stock prices fall 30 to 40%. In some countries, it can drop up to 50 to 60%. During the Asian financial crisis, property prices have fallen from the peak in 1996 Q2 to all the way to the bottom of 1998 Q4. It has fallen 44.8%. During the same period, stock prices have fallen from the heights of 1996 Q1 2,400 points all the way to the bottom in 1998 August 800 points only. It has fallen a total of 66%. In the last financial crisis, from Q2 2008 to Q2 2009, property prices has fallen 25%. Stock prices have fallen from the peak of 3,800 points all the way down to 1,400. Stock prices has fallen a lot more, up to 60% at that time. What about return and capital appreciation? If you invest in shares, the only return that you have will be the dividend from the company. Whether the company is paying dividends, what's the percentage of payout, and whether there will be special dividends. And that's the return you're going to get from stocks. Versus if you invest in properties, the only return that you get is from the rental payment from the tenants. Then you have to worry about whether there will be late or missed payments. When are you going to send a late payment reminder, or when are you going to send an ultimatum, and whether and when are you going to lock the tenant out. But in terms of capital appreciation, if you manage to buy a very good property at the right time at the right price, the return is much higher. For example, last time I bought my properties at a very low price, and then I only put down 20% down payment and bought 80% from the bank. So when the value of my property doubles, and it really increases my capital 5 times. And it's quite difficult to do this in the stock market unless you are able to find a very good gem in the stock market. It sounds really more complicated and more capital and time intensive investing in properties compared with stocks. So why are people like me still investing in properties? It's because the game is more difficult, and it's more difficult to pay and more difficult to win. So that makes the whole game more fun. So whatever investment vehicle you have chosen, I wish you good luck. That's all I have to cover today. Thank you very much for watching. See you again soon.